Give us your take on where we are. We have these competing forces. Geopolitics really are weighing on a lot of investors' minds at the moment. At the same time, we hear the fundamentals of the U.S. economy are strong. We hear that time and time again. How do you reconcile these?
Sure. I think we've had a great couple quarters. The unemployment rate and inflation rate are pretty much just where we want them to be. But we're still not seeing productivity growth. So once we're done with bringing people back into the workforce, where the growth above about 2% is going to come from is really hard to see. That's without the geopolitical uncertainty. Then you add the geopolitical uncertainty into that, and it gives you, an additional reason for a sort of medium-term worry, not necessarily a short-term worry.
So your old job at the White House wasn't to try to set monetary policy, but as we look at the Federal Reserve right now, how should they be interpreting the data, and what should they be doing? Are we talking about another interest rate hike in December? What do we do going into 2019? Where are they?
Look, Chair Powell rightly stated at the last press conference that they're going to be much more data dependent. He basically said, don't look at the dots as much as people have in the past. They also said they're going to be raising in December. That's what the markets expect. I wouldn't do it, though. I think financial conditions have tightened with markets down, with interest rates up. So I think while a rate hike in December was appropriate before, we've basically gotten that rate hike on its own through the market. And so it's a good chance for the Fed to show us that they're being data dependent and taking that into account.
That's a great point. Also, though, the question becomes if the sugar high from tax cuts can be extended in some capacity, does that change the game? And over the weekend, we got that surprise announcement from President Trump at a rally that there are middle-class tax cuts on the horizon. Here's what he had to say.
We are going to be putting in and are studying very deeply right now, round the clock, a major tax cut for middle-income people. Not for business at all, for middle-income people.
Whether or not that's going to happen, let's put that aside for a second. Could that really extend the cycle here?
Look, the sugar high is going to extend into 2019. If you look at the combination of tax cuts and spending increases, they're even bigger in 2019 than they were in 2018. They only start wearing off in 2020. So I think we have a little bit more to play out in the fiscal stimulus. And you're right, another log could be thrown onto that fire, to continue to mix this metaphor, to extend it out even further. But the thing that's inevitable is it will come to an end at some point. You can't just keep doing more and more fiscal stimulus. At some point, we're going to crash out of that.
Well, there's always a cycle. I guess my question is it sort of a law of physics or economics that the higher you go, the farther you fall? That is to say, would we make it worse by extending the sugar high at this point, or is it just going to come sooner or later anyway?
Yeah, it depends on, why you rise high. If it's something like productivity growth, that's a good reason for the economy to do well, and that's something you can sustain for a long time. Right now, that's not what we're seeing. What we're seeing is a lot of demand. It's bringing people back in. It might pay off in terms of productivity. The numbers are noisy. It's hard to know, in real time what's going to be around the corner for it. So it might, but, right now I'm just not seeing evidence of it. So, yeah, I think there's a limited amount of time we can have these very high growth rates.